Welcome to Celebrity Investing, your go-to source for insights, tips, and updates on navigating the exciting landscape of personal and global finance. Please like, share, and subscribe for more exclusive content. This is part 2 of Mastering Bond Convexity, Key Insights for Smart Investing. Types of convexity. In the world of bonds, convexity is a powerful tool that helps investors understand how bond prices change as interest rates fluctuate. Not all bonds are created equal, and understanding the types of convexity is key to mastering bond investing. Let's dive into the nuances of positive and negative convexity, and how convexity plays out in callable bonds. Positive versus negative convexity. Positive convexity means that as interest rates fall, the price of the bond increases at an accelerating rate. This is typically seen in traditional bonds. Investors love positive convexity because it means they benefit more when rates go down than they lose when rates go up. Characteristics of positive convexity. Bond prices rise sharply when interest rates drop. Price falls are more gradual when interest rates rise. Provides a cushion against rising interest rates. Negative convexity flips the script. It's commonly associated with callable bonds. With negative convexity, as interest rates fall, price increases slow down. It's like the bond is stuck in molasses, moving slower than expected. Characteristics of negative convexity. Price increases slow when interest rates drop. Price drops can be more severe when interest rates rise. Adds risk since bondholders can be caught off guard by falling price benefits. Why does this matter? Recognizing these characteristics lets you anticipate how bonds in your portfolio will react to market shifts, helping you to strategically allocate your investments. Convexity in callable bonds. Callable bonds introduce a wrinkle into the convexity conversation. When issuers have the right to buy back bonds before maturity, it adds unpredictability. Understanding convexity in callable bonds is essential due to a few unique traits. Callable bond characteristics. Issuers can call the bond when interest rates fall, capping the bond's price increase. Investors face reinvestment risk as they're forced to reinvest at lower rates. As interest rates drop, the likelihood of the bond being called increases. This callability introduces negative convexity, making callable bonds less attractive when rates fall. Risks in callable bonds. Limited upside. The potential for price increase is capped once the issuer calls the bond. Enhanced volatility. Callability adds layers of uncertainty to bond price changes. It's like sprinting towards a finish line only to find out it's moved. Managing this risk is crucial, and understanding convexity helps you assess the trade-offs between yield and potential pitfalls. By grasping these dynamics, you can align your bond strategy more effectively with market conditions, steering clear of the traps laid by callable bonds and leveraging positive convexity to your advantage. Limitations of convexity. Understanding the nuances of bond convexity is essential, but it's equally important to recognize its limitations in analysis. While convexity provides depth to interest rate risk assessment, several factors can challenge its application and accuracy. Assumptions in convexity calculations. Convexity calculations rest on certain assumptions that could skew results if not carefully considered. These assumptions can lead to discrepancies between theoretical models and real-world outcomes. Constant interest rates. The classic convexity formula assumes interest rates change uniformly, which rarely reflects the real market. Markets are unpredictable, and interest rates can jump erratically, challenging this assumption. Static cash flows. Convexity often assumes fixed cash flows, ignoring factors like early bond calls or defaults. Callable bonds, for instance, can disrupt expected cash flows, making convexity less reliable. Price yield curvature. The model presumes a specific price-yield curvature, which may not align with market behavior. The reality of the market's nonlinear response can throw off convexity predictions. These assumptions highlight why some investors see convexity as a helpful guide rather than a definitive answer. It's crucial to question these assumptions in each analysis to achieve more accurate forecasts. Market dynamics and convexity. Convexity's reliability can also falter with changing market dynamics. Let's explore how market conditions influence convexity's effectiveness. Volatile market conditions. In turbulent markets, the curve of bond price changes becomes less predictable. Convexity might not capture the full extent of price volatility, causing unexpected swings. Interest rate environment. During periods of rapidly changing interest rates, convexity's predictive power weakens. Traditional models may fail to account for abrupt rate shifts, limiting their usefulness. Policy changes. Government or central bank interventions can abruptly alter interest rates, impacting bond prices in ways convexity might not anticipate. These policy shifts inject an extra layer of uncertainty. While convexity remains a vital tool for bond investors, understanding its limitations is key to wielding it effectively. This awareness ensures a more balanced view, helping investors navigate both the predictable and unexpected paths of the bond market. Wrapping up bond convexity. Grasping bond convexity is like having a financial crystal ball. It gives investors insight into how bond prices might dance when interest rates change. This understanding is crucial for managing risk and seizing the right opportunities. Highlights of bond convexity. Interest rate sensitivity. Convexity helps predict how much bond prices will wobble with interest rate shifts. Risk management. It acts as a safeguard, showing investors how bond sensitivity evolves over time. Portfolio performance. Understanding convexity means you can optimize bonds in your portfolio for smoother returns. Positive versus negative convexity. Positive convexity means gaining more when rates drop, while negative can mean hitting a ceiling on gains. Callable bonds. These add complexity due to potential early redemption, introducing unpredictability. Key takeaways. If you're in the bond market, or thinking about jumping in, convexity should be part of your strategy toolkit. It's not just for the experts, even everyday investors can use it to make smarter decisions. With convexity, you're better equipped to read the financial terrain and adjust your holdings accordingly. So, do you think you're ready to tackle your bond investments with the added insight of convexity? Let it guide you through the ups and downs, helping you turn potential setbacks into opportunities for growth. Stay tuned and continue to watch our videos to gain valuable insights into the world of finance. Subscribe, like, and share to continue your journey to financial success.